Well, good morning, everyone. For those of you that are new here, my name is Sonia Jenkins. I'm a partner and branch manager here at Owens Estate and Wealth. I'm here with my colleagues, Peter Ketchand and Dylan Blomgren. And the goal of this morning is our third quarter Q&A, economic update, market update, just to kind of touch base with all of you and let you hear what we're seeing going on in the market, what we're seeing in the economy, how we play that forward, and allow you guys to ask questions. As in the past, this is a dynamic presentation. So if you have a question, feel free, raise your hand. It's part of why we make you wear a name tag so that we can acknowledge you by name if we can see it. But we do encourage you to ask questions. But I will also remind you that we stay very neutral when it comes to political agendas. We respect everyone's viewpoint when it comes to politics. And we think that that's a really important philosophy to maintain in this environment. So just so I don't expect anything out of the ordinary. We are recording this session because we want to be able to provide the same information to clients who weren't able to attend today. So just know that that is happening. And if you have any questions, feel free to let us know. But I'm going to go ahead and let Peter take over and kick us off.
Okay, so as Sonia said, I'm Peter Ketchand, one of the partners here and also the director of research. When we've done this, I point out these are the disclosures that we had to show you, but they are in your presentation. So to start off, this is a chart that we affectionately call the jelly bean chart because it's got all the different colors, and so it's a big pile of jelly beans. But basically, what this is showing you is the different returns, the asset class returns. So each color stays the same. So there's U.S. large cap, the S&P 500. We have emerging markets equity. Fixed income is the bonds. Commodities down here at the bottom, but also sometimes at the top. And the big point of this chart, especially over since 2010, so a pretty long time frame, is that you can see that the asset classes can have wide swings in how they do in a calendar year. So as you can see at the beginning of this time, REITs and real estate, they were at the top 5 out of 6 years. And then they've turned it down, and then they're at the bottom here. U.S. large caps, as we know, have done. So this is the one that is kind of the average, this line. So annualized. So you can see U.S. large caps started out in the middle coming out of the great financial crisis, but they've lived here close to the top, though in 2022 we had not the greatest. This dark purple is cash, which again, cash hasn't returned a lot, so it's been close to the bottom. But here in 2018, when everything else did not so great, cash is at the top. So that's the look of this chart. So, but the main point of this chart is this white one. So, and they conveniently drew a line for you, right? So I don't have to laser point it as much. And it's this asset allocation. And as you can see from the asset allocation, it lives in the middle here. And actually this 7.2% annualized over 15 years is still pretty good. It's not the best, it's not the worst. Same thing in each year. It's not the best, it's not the worst.
And Peter, is that a 60-40 asset allocation? Is that the allocation there?
I mean, this is roughly 60-40. It includes, because it has commodities and REITs, it has commodities and REITs and equities, international equities, emerging market equities. So when we think about investing, right, and for all but the most aggressive people who want all stocks or something like that, the asset allocation is the combination of stocks and bonds and other type of investments, maybe some alternatives, maybe commodities, real estate. And so that mix of investments that a person is invested in according to their investment objectives and risk tolerance is their asset allocation. So when you have, the most basic, Sonia mentioned, is 60-40. 60-40 is 60% stocks, 40% bond. And then stocks can be broken up. When you look at this chart, they can be broken up into U.S. stocks, international stocks, emerging market stocks, even REITs. Like REITs is real estate, but it's real estate stocks. So, and then you have cash and bonds.
So when you say asset allocation here, what you're saying is this is what Owens is doing with it?
No.
So what is this particular?
This asset allocation is just an.
You can see it at the bottom of your slides if you want to read it. But it shows the exact asset allocation they are using in this example, which is going to be similar to ours, but I mean, at the same time, different. We have our proprietary models.
And we have allocations that are more conservative than this one and asset allocations that are more aggressive than this one. Again, that's why I talk about this is a general statement, but each of you will have your own investment objectives and risk tolerance that we work with you to determine when we're having a meeting with you. So basically, yeah, so this is what I was getting at. So when you are looking at your asset allocation, we are trying to achieve something like this. We're trying to achieve returns that are going to be somewhere in the middle of whatever is doing the best that year, which again, you can see it's been any number of things, and whatever is doing the worst that year. And we are trying to make sure that, so in exchange for not getting, nobody wants the worst. So in exchange for not getting the worst, we're not always going to be in the best because we're in a basket of different things, and we're trying to keep that relatively static. Part of our role is to make changes to that we think would be beneficial, but it's not going to say we're going to make this big change and we're just going to go way out of the allocation for 6 months. That's not how the process works. Okay. And why is this? Again, why? Now we go from that theory to here's the practice, right? Because we're looking forward and we're saying, how does this play out? And that's why we have markets, right? Markets exist because some people have a positive view and some people have maybe a negative view or a differing view, right? Somebody today, millions of people are selling Apple, right? Today, because they think Apple is ready to be sold. But on the other side, there's millions of people who just bought Apple from them because they think Apple has the future prospects that they want. So just kind of to look at where we're at, right? So beneficial, here we are. This is the real GDP growth. You can see the trend growth is 2.1%. And here we are. We're sitting on the trend line, which again, there are commentators who say, we're going to continue this nice trend or not. It's not going to be expansive, but if we continue at this trend line, we're going to see that would be more beneficial for those things that you see, where the stock market is perhaps going to continue to benefit from something like that. A negative, right? We have a government shutdown. We don't know exactly what's going to happen with that. Most of them get resolved rather quickly. So we're watching that. That is one of the things that would say, hey, maybe the more defensive parts of your asset allocation are going to be a benefit to you. And here we are. We see a lot of the GDP is people buying stuff, consumption. That's what that means. That means basically buying goods and services. And we can see that the consumer here is strong, right? This is the asset side, and this is the liability side. So on a whole, in aggregate, the consumer has assets that they can spend. In terms of the income portion, Sonia's going to get into the job market. So that's the income side of the ledger. But again, you can see the financial assets, pension funds and other financial assets, stocks and bonds, what we're talking about, make up a good chunk of it, right? But you can also see that if we have a market downturn, which markets will turn down, that's part of being in the market and getting the return that you get, is that, even a large downturn would not bring us down to this where the assets would not still outweigh the liabilities. So that puts the consumer in a good spot. You can see that people aren't spending a lot on their debt. I mean, it has come up, but you can see we're still below that pre-COVID line. So that means that for now, I mean, again, Sonia will get into the labor market, but people are relatively comfortable in aggregate. I mean, I know that there are people that are struggling, but this is sort of an aggregate look. And then same thing with our credit delinquencies. They have come up a little bit with credit cards and mortgages. The student loans popped way up, but I mean, that has to do more with some of the dynamics of the student loans. They were deferred, or under the Biden administration, they didn't have to pay their loans for 5 years. And so now people are grappling with that. And then there's this is a potential negative. So again, this is another chart. So it's kind of a messy, well, not messy, but it's a scatter plot. So it's kind of scattered. But what this tells us, mainly this area, each of these dots is a yearly return, each of these little diamonds. And this is kind of like the center line, the average, what they call the regression. As you can see, in a statistical format, the forward outlook, the 5-year forward outlook for stocks is very challenged. But however, you can see in this up here, that would be a situation where the statistic did not play out and they had a good return. So from a valuation standpoint, or the value, how much we're paying for stocks as a whole, which is the S&P 500, so that's US large cap, we are looking at, the potential for maybe stocks to not do as well as they have. I mean, because, to be honest, they've done 14% a year for the past 15 years. I mean, the S&P 500, the US large cap, and that is quite elevated, historically. So even if they don't do zero, there's a chance that there's a very good chance that they won't be doing 14% either. But as you can see, there is a chance that they will. So that's, again, going back to the asset allocation concept. We don't want to abandon the stocks just because we're like, oh, look at this chart. It says they're not going to do anything. So
what are the individual dots represent?
A year of returns. So,
but for a given year, may have multiple dots.
Oh, so yeah. It's a rolling annual. So that's a 60-month annualized return beginning in 1993. So,
for example, you were circling the ones that are higher.
Yeah.
What are those? Are those specific stocks?
Those are specific years, but those are specific
60-month periods where the market returned well above what the trend line or the line would suggest. Okay. So here's another thing. Again, this is the tariff rate, okay? And it had really settled down and people had relaxed until last Friday, kind of picked up again. And now we've had a few back and forths, but this is where we came out sort of at the top in April, and here's where we were at September 30th. And now, so a real trade battle between the West and China would create likely a negative outcome, right? And so that is something that we are looking forward towards. Again, it seems to me that we're moving towards a resolution of some sort. I don't think anybody wants that. Anybody being China or us or Europe, that's not something I think that would be beneficial. However, as they move towards that resolution, there are always chances for things to go wrong. So that, again, this is something that you would say that is on the part of the asset allocation that you would be more conservative. And then finally, this is inflation's kind of a double-edged sword. We have inflation that has really, we got below 3. I know that the Fed says we're going to go to 2. However, perhaps we could live in the 2 to 3 range, and that would be okay. Maybe the Fed will stick hard to that policy target of 2%, which may lead them to hold interest rates higher longer than they should. I don't know. However, we do see it trending up. And so if inflation continues to trend up, then it becomes a question of how the interplay of inflation and jobs starts to interact in terms of the effect to the economy. So again, the point being in all this is when you look out now, there are definitely things that would cause you to have a good outlook on the markets. And then there are definitely things that are of concern. And that goes back to why we employ an asset allocation, because any one of these things might be the thing that pushes those stocks higher or lower. And then you benefit more from more conservative investments in your asset allocation.
So are you are you thinking the 60-40 that seems to have been around forever, you think that's going to change? I mean, because we could count history, and you can't do that anymore, or it doesn't seem like you can.
I mean, okay, so, the 60-40, I think, is, again, a time-tested way to invest. I think that there is, so to say that it's not going to work anymore I don't know that it's correct. I think the 60-40 has done very well historically in the last 15 years, mainly stocks have done so well, and with lowering rates, bonds have done pretty well too. So I think the question is it going to, with the traditional 60-40, get you to the 7.2% that it has here for the last 15 years? I mean, I think that may be challenged. I think that from our own perspective, like adding in other, people talk about 50, 20, 30, right? So 50 stocks, 20% alternatives that do different things, and then 30% bonds. Like there are other theoretical constructs out there, but I mean, in reality, for most of investing, it's like stocks and bonds are still going to be your primary investments that you can invest in a financial world. So,
but I think to your point, Paul, diversification is important, right? I mean, a lot of clients ask, is there going to be a large correction? Should I be making radical changes? And that's part of what we do here with our investment committee. We believe in our asset allocation. We believe in diversification. We're not going to put all of our eggs into one basket, because that's where you elevate your risk profile, when you put too many eggs in one basket. And you can see, like Paul, I think looking like, okay, well, are commodities a component of your asset allocation? They may be, right? They might be a really attractive component at this point. Or is real estate a component of your asset allocation, of your diversification profile? And so when we talk about our asset allocation, it's never stagnant. We always, with our clients, allocate to their risk tolerance, but we're going to diversify across asset classes. And I think that question of, is the true 60-40 stocks and bonds exclusively the gold standard anymore? And there's a lot of schools of thought around that. And there's times when absolutely that 60-40 is going to outperform the 50-20-30 strategy, and vice versa. And so that's where you want to work with your advisor to say, is it time to make a change to our structure? And that's where we, as an investment committee, we may choose. We added alternative investments to the bulk of our discretionary portfolios a couple of years ago, kind of pulling away from that gold standard of 60-40, wanting to have some alternative investments to provide returns. And so it is interesting. And I think with the advent of crypto and all of that, we do not invest in crypto in our clients' portfolios, just to be clear. It's not a risk profile that we feel is appropriate for every person. But it's an evolution all the time.
But the things that, at least in my mind, that we were always basing it on was somewhat consistent. But people are just so reactive right now in the market and in healthcare. I mean, I know 3 people that canceled their healthcare this year.
Wow.
Yeah, just because they're getting these notices now, what could happen.
Yeah.
Which creates a bad reaction.
Yeah, and I think that's where having someone that you can talk to before making decisions. It's part of what I love about our team environment, is that it takes the emotion out of our decisions. Because I will say there is a lot of emotion that gets stirred up in our media. Headlines, emails that drop into your inbox. If you're on social media, things that get pushed into your algorithm, they're designed to create an emotional response. And And if you act on that emotion, it's not generally going to be in your best interest. You want to kind of take a step back and evaluate that of like, okay, well, where's the truth to this? Like, what assumptions am I running on when it comes to that? And I think that's one of the biggest challenges in today's environment. We're a 24/7 news cycle, right? And news industries want you to watch them. And so they're going to maybe inflate a little bit their headline, right? Just so that you'll click on it, maybe just a little.
If everything's all sunshine and rainbows, no one's going to watch what's on the news. If it's a little scary, you're more likely to pay attention.
Yeah. And so I think that it's a challenging time for individual investors because you're fed so much. And that's part of why we like having these conversations once a quarter to kind of weed through that noise and do the best to have those open conversations about our perspective on what's currently occurring in the markets and in the economy.
Well, and the last thing we want to do is also pretend like there's no challenges or, things on the horizon that are not problematic. And that's what we're trying to, or I was trying to illustrate, is that there are good things that we can identify and that have a reasonable probability of happening, but there are also these challenges that are going to be there. They're always there, but I mean, sometimes they feel more elevated in terms of the potential that they're going to happen, and that's when you see the market get really more skittish.
Mm-hmm.
And to your point, things are happening quick and quicker than we've had in the past. I mean, with social media, with cell phones, we're getting information very quickly. And we've seen some major market movements that happen, a big drop and then a recovery. I mean, with COVID, in March of 2020, the market fell off a cliff, and by June, it was fully recovered. I mean, we saw the same thing in April of this year. We saw a massive drop, and now we're up 14%. Things are happening quickly, and it doesn't make sense to make a rash decision.
Yeah. Patty, you had a question?
Yeah, I think, well, first of all, we no longer have both concrete. Concrete, and a few others for an opinion. There are so many outlets where you get the news that you feel make comfortable with. Did you good, bad, jump off the cliff, whatever. But what I do think is that there's new information I know I don't understand, like stagflation. What are the tariffs going to do to the market? So what I have done is I just checked out and I just look at I just log into your website like every 2 weeks and said, on the cliff, off the cliff. And that's, and so the question for me is, there is a lot of different activity. It's global, that's partisan, that's international. I mean, I say that twice, but we had a big day yesterday. And how do you all just juggle that?
Yeah.
How that intersecting information when you make that decision to go from 60-40 to 50-20-30, or you just we all hold hands and just go together?
We don't. Okay. We don't. So I will say we rarely make decisions quickly. I mean, certainly there have been times. COVID was one where Peter came to us and he said, we've not been in this environment before, and I can't give a statistical assumption of where we're going to go. I think that this would be one of those unique periods of time where we should be overweight to cash pretty significantly. That's a retrospective look, but there are times when you can't quantify the risk, and so you do act accordingly. But at the same time, with this 24/7 news cycle, generally we're not jumping to make decisions because, as you could see, from Friday to Monday to Tuesday to Wednesday, vastly different market environments. And so if there was a panic sell on Friday, well, now that wasn't really in our best interest. That was an emotional response. And so we do a lot of reading. We do a lot of discussion. Not all of us are we are not all the exact same person. We have different political views. We have different educational backgrounds. I love that because we're not a rubber stamp committee. And Peter is excellent at, even if he agrees with me, he will challenge me for an hour to justify why I feel something, needs to be done or doesn't need to be done. And that, I think, is a great way to kind of weed through the noise and decide, when do you jump and when do you take a moment to just, okay, let's see how this plays out. What's the magnitude of our risk at this moment? And look at it.
The risk feels very high, particularly with the house.
Yeah.
Like all the things, I just peaked them, but it just felt like a very risky time, and
people are playing with matches and no one's watching the house. So
yeah, we call those the bricks in our wall of worry. There are always a lot of bricks in that wall of worry, but 95% of the time that brick resolves itself without becoming anything meaningful. But sometimes the resolution can take longer than we would prefer. So yeah, that is a current pretty big brick in our wall of worry of how long is the government going to be shut down? How's that going to impact GDP? What's the ripple effect of where we sit right now? Are we going to go back to the last time we were shut down for this long or longer? How do we move forward from here? Yeah.
Thank you.
Yeah. I'll pass the baton back to you, Dylan.
Alrighty. Thank you, Peter. Hi, I'm Dylan, financial advisor and a partner here as well. Today, I want to talk a little bit about the concentration in the market currently and the overall kind of top heaviness, if you will. Right now, the top 10 companies by market cap make up 40% of the S&P 500. We've never seen it that high, but at the same time, their earnings somewhat justify that. You're getting the top 10 market cap are making 32% of the earnings. Although it's not quite at the same level of that 40%, you're still getting a good return on those top 10 companies. We are nowhere near the levels of the price to earnings ratio that we saw at the dot-com bubble. Right now, the top 10 companies in the S&P are at almost 30 times the price to earnings ratio. The historical average is 20, and right now the remaining companies are at 19.5, whereas the remaining companies are normally at 15.8. So everything right now is a little bit pricey. But if we go on to the next slide, we can see that the return from the Mag 7, this is going to be we like acronyms in this industry, right? We've had FANG over the years, but overall just U.S. large cap and U.S. large cap tech, right? It's been on a heck of a run, and the earnings are showing that it's justified the run. They're making more money than other companies at the bottom half of the S&P 500. So is this going to continue forever? No, probably not. As we saw from the jelly bean chart, there's years that U.S. large cap tech does amazing, and there's years that it doesn't. The overall average is going to come back to norm, but when is that going to happen? Here we go. So we go back by decades. These are the largest companies in the S&P 500. Right now, like I said, we're at levels we haven't seen. We're at the 40% level, right? If we look back just 10 years ago, there's only 4 companies that are currently still in the top 10. If we look back 20 years ago, there's only one, and it's Microsoft. If we look back 30 years or more, there's 0 companies that are still in the top 10. As times change, as technologies change, companies change. So are all of these companies that seem like they're going to last forever going to? Probably not. When is that going to change? No one knows exactly, but we are updating our portfolios all the time as we get new information. Here we go. So these are the earnings over the last couple years of the Mag 7. And like I said, they've been awesome. In 2023, 2024, and this year, they've significantly outperformed the rest of the S&P 500 and of the S&P 1000, which is going to be the mid-caps, medium-sized companies. Looking forward to 2026, we actually see that mid-cap companies are projected to have better earnings than forward-looking earnings than the Mag 7. Are we starting to see the changes? Possibly. This just goes to show the importance of diversification and asset allocation.
Would you attribute the Mag 7 earnings to their crazy acquisitions? I mean, I think some companies bought each other by accident twice, and it plays in their stock price.
Yeah. Yeah.
Well, and also you can see a lot of these companies have the magical AI surrounding them, right?
Right.
I think we're going to see some changes in the coming years, but when that shakes out, no one knows exactly.
Now they're just buying each other.
And when you say that those earnings are projected to increase, who's making that projection?
It's a composite of all the analysts that cover those stocks. So it's not necessarily one person saying it's going to grow X. It's like they take the current group of analysts that cover that stock and then they put it all together in the 500 stocks. So it's a composite number of people who study those stocks on a regular basis.
It's more than one brain.
Yeah.
Yeah. Tim.
In the October newsletter that you sent out,
Yeah.
The internationals seem to be doing much better, twice as good as the United States. How much collectively do you have invested in the international stock versus domestic?
It completely depends on your goals and age. I mean, we're not going to manage the same for someone who is 30 as the same as someone who is 70. So our portfolios differ on our percentage of international depending on your risk tolerance.
I will say, though, that it's greater than it's been in the past.
Absolutely.
Yeah. Any other questions so far? So passing it on to me. So now we'll kind of get into the economy a little bit and how this all pulls together from, where the economy is currently sitting and why that pulls into diversification and asset allocation within a portfolio. So this particular graph is just looking at the current 3 quarters of 2025. And this is the economic indicators that are largely used for determining the health of the economy as a whole. And it's pretty straightforward. Green is good, expansionary, growing. Yellow is cautionary, meaning that things are slowing in that particular sector. And then red means that it is in a recessionary position. And so you can see there's been a little bit of changing. Housing permits have come down from expansionary in the last quarter down to a more cautionary position. I think that's largely driven by a lot of interest rate concerns. We stayed in a higher interest rate environment longer, and you have a lot of these builders that are buying down rates as a way to sell the homes that they're building, and you can see that they're watching their own balance sheets, so maybe they're slowing the ability to push out those new homes and build until we see a meaningful pullback in the interest rate environment. Whether or not that meaningful pullback will occur remains to be seen. There's a lot of thought that goes into that. Housing permits being in a cautionary position is pretty interesting for the housing market as a whole because we're already underbuilt. And so the demand continues to stay strong in the housing market for existing homes because we don't have enough homes being built in the United States to keep up with demand. So that's one of those things that will help keep the real estate market from having a meaningful correction at this point when we have an undersupply of homes. Things that moved. ISM new orders, that moved from a recessionary position into more cautionary, so moving in the right direction. That's kind of a reflection of things kind of settling out in the tariff department prior to last week. So uncertainty continues to remain in that world, but it was less so than it was in March, and certainly resolving even more since the end of June as well. And then, everything else is pretty well similar to where it was in the prior quarter. This is a historical. Sure.
So I look at some of these and I go, huh? It don't make sense. Like jobless claims. I mean, those presumably are accurate statistics. Yeah. But with all of the people being laid out from the government and everything else, how can they have been an expansionary
I'll show you.
indicator?
Yeah, I'm going to jump forward real quick to this. So this is kind of the labor demand, job openings, the quits rate, and job layoffs. And you can kind of see by each of those graphs that we're kind of just reverting to a pre-COVID environment in all of those. So yes, we've had an increase in layoffs over historical periods of time or over recent history. But if you look back even further, and this is in your bottom right-hand corner, the layoffs are still below pre-COVID rates. So that's why it's still not considered recessionary because we're below the historical norm in that environment. The quits rate, it's It's come down quite a bit. People are not quitting their jobs like they were in the COVID era because they aren't certain that they could go out and quickly find a replacement position that's going to pay them greater than what they're earning now. In the COVID era of 2020 to 2023, you saw a lot of job changing and people were getting vast raises for moving between companies. And that era has it's behind us now. Now, wage growth inflation is still positive. It's at about 3.8%, 3.9% versus inflation is at 2.9. So we're still seeing some positive gaps there. But you aren't seeing people quitting their jobs quite as often because they aren't certain that they can find a replacement. And then the job openings, that's, I think, one that we have a little bit of questions around the validity of some of that information. We've seen quite a few pretty significant revisions to those numbers over the last 6 months. And so it's something that we'll continue to keep an eye on how are things going. But at this point, based on the information that we have at hand, job openings, they've come down from their peak, but they're kind of settling out to where we were prior to the COVID era. I'm going to jump back real quick, though, just to the historical recession dashboard to just kind of show you, of those indicators, right now, we don't see the immediacy of a vast recession, but we do look at things trending. Now, it's in a moderate position, I would say. There are bricks in our wall of worry that could tip the scale one way or another on each of those indications, and we keep an eye on it. But when you look at the health of the economy as a whole at this point, I would say it's doing okay. Is it fantastic? No. Is it dire? No. We're doing okay. We're hanging in there. And so, that go, okay, the world is it's not as scary as some things might lead me to believe, but there are certainly things to pay attention to. And then just looking at the historical information on unemployment versus wage growth inflation, we're still below long-term averages on both of those. We're doing well on the wage growth inflation at 3.9%, with inflation at 2.9. So you've got about a 1% differential for the workforce on what their wages are growing by what inflation is doing to erode their purchasing power. So staying in a positive position. And for those that are in retirement, the market has continued to hold its own. And so when you're living off of your investments and using that prudent distribution rule, you're doing okay because the market has held its own. And that's where having those conversations with, okay, but how would I do if there was a 20% correction? How would things look if the market had a meaningful pullback for those that are currently in retirement and living off of their assets? But for the workforce as a whole, California may be slightly different than the rest of our nation, but for the workforce as a whole, their wage growth is largely keeping up with inflation, which bodes well for keeping the economy in a stable environment.
I don't think if you ask people, they would agree with that.
There's a lot of anecdotal consideration, Rick. You're right. But you can also talk to other people that say, I'm doing fine. You're going to get things on both ends of the spectrum. And I think that the anecdotal component is important, because you want to hear from various economic sectors or socioeconomic sectors. How are they doing? And no matter where the economy is, whether we're in a boom or a bust, there's always going to be those on each side of the spectrum that are doing just fine and those that are struggling. It is a true statement.
I mean, again, as I was saying earlier, I used the term in aggregate. These are aggregate. Mm-hmm. This is aggregate data. I mean, when we look at that consumer balance sheet, there are people that have way more debt than assets. I mean, in aggregate, that's not the case.
So kind of pulling that all together of okay, the economy seems okay right now. We have a lot of bricks in our wall of worry. We have things that we're paying attention to. But, what does that mean for investing? And what the markets are at an all-time high. Is now a decent time to get into the market? And so I think that this graph is interesting of returns when you're investing at all-time highs is really actually not necessarily a bad thing. There is such thing as momentum. Now, momentum may not always continue. We've always, markets pull back. They do. But it's also not necessarily a reason to avoid investing in the market because it's at an all-time high. And so you can kind of see investing on any other day of the market versus the day that the market hits an all-time high. If you look at the bar chart on the right-hand side of the screen, you're doing pretty averagely well. You're not necessarily making, large bets when you're putting money to work. We still believe that dollar cost averaging in over a period of time with new money is not necessarily a bad thing. But I also would say it's not a bad time to be in the market either. There are good reasons why investing will continue to do well for a while. And there's good reasons to stay diversified when you're doing that investment process so that you don't put all of your eggs into one basket.
And I mean, this chart is from 88. So, but here, I mean, that's about here. So I do want to point out, I mean, and goes back to asset allocation and being conservatively invested, kind of the way that we think about things is that there are times, like, again, this is a big chart and it goes over a long period of time. We remember those 13 years where from 2000 to, 2013, the market was very volatile, it minted a couple all-time highs, but that wasn't to your benefit to buy. And, we have going back period where I was born, I don't remember, but the 70s also. So again, before we want to say, like, you can see it's not any better or worse, but there are times where the markets can be, not have that new all-time highs coming for you for longer periods of time. So again, it just goes back to that idea of that's getting that 4% from bonds feels really good when the markets are down and they're just, they're not creating this upward momentum for a while.
And I'll let Dylan go over this graph with you to kind of talk about time in the market.
Once again, the importance of diversification here. So I think the 60-40 has gotten a bad rap recently, mainly because in 2022, the Fed raised rates at a rate that we have never seen before, and it decimated the bond market. So it was a really poor performance for the 60-40. But if we look back over the last 75 years, back to 1950, if we look at a 5-year period or longer, a 60-40 portfolio has never been negative. In a 1-year period, you're likely to see either, stocks or bonds go up a lot or negative. In this circumstance, we see, the down 37%, that was in 2008. Same thing with the bonds. You had a lot of protection from just a 60-40 portfolio there. But if we, take a step back and look at the 5-year, the 10-year, the 20-year, you're getting a lot of protection in a 60-40, and it just shows the importance of diversification. I mean, if you look back, the total average annualized return is 9.4% in the 60-40 compared to only 11.6 in bonds. In stocks. And then bonds down at 5%. So, adding a little bit of protection, diversifying across really does help in the long run, even though in any 1 year, it might not feel like it.
And so kind of all of that to say, we've gotten a lot of questions about what should I do? Is the current environment going to erode my portfolio? Should I be looking at making radical changes? And that's where we would come to you and say that this is where, one, being true to your tolerance for risk is very important, and having those honest conversations with your advisor is paramount. And two, because we all love up markets, right? Everybody loves when the markets are rising, and maybe I should take more risk. Maybe I should add more growth to my portfolio. And we would always come back to you and say, okay, but what when the market turns? I can't tell you the day that the market's going to turn, and so I'd rather prepare you ahead of time for the eventuality of that. And so when you look at this in its entirety of where the markets sit, where the economy sits, and where investors sit on a whole, this is where we just preach day in and day out. Diversification, asset allocation, be true to your tolerance for risk. And that's the thing that gets us through when we enter challenging periods of time. And it's our goal that when we do these quarterly updates with you, that we can have that opportunity to have the conversations with, how are you feeling in this environment? When the markets are continuing to do well, we all feel pretty good. But really, we want to make sure that we've had that open conversation with each of you well in advance of when the markets have that pullback, because we know that that happens. But it's our ability to stay the course during that pullback. And to Peter's point, asset allocation, diversification, that's where you're not intending, the goal is to not feel the entirety of the movement of the market on either the up or the down, right? Because we want to be able to stay true to how we invest. And I think this last slide is a great testament to, annual returns in the market, intra-year, those red dots versus where the market finished. And you can see there's some pretty low red dots on the intra-year. We always capture markets in a calendar year basis, even though they are perpetual. But we single them out into each calendar year, and you look at how far down did the S&P 500 go versus where did it finish at the end of that calendar year. And there are a lot of really big geopolitical events that have happened since 1980, but you can see that things have, patience is a virtue sometimes. It's not to say become complacent, but patience is a virtue. Nancy?
So we watched 60 Minutes on Sunday, and I don't remember the name of the man who was the author of the new book, 1929. And so I wonder, I don't know if you know who I'm talking about.
Andrew Sorkin.
Thank you, Andrew Sorkin. And so because he was analyzing everything from the crash to 29 and making comparisons between that time and the time we're in now. And I wondered what your thoughts were on that.
I will. Yeah, no, I think that those big periods, they reside in the back of our minds all the time. I was reading an article this week talking about how where inflation sits right now is very reminiscent to the charts of 1970. And are we going to go into the same period of time such as that? And it is really hard. I mean, we always use history in order to, look forward of finding relevance between two scenarios. That doesn't mean that they're identical, but it does mean you pay attention to the relevance, and does it warrant making an adjustment to the portfolio? I'm going to be completely transparent. I was on an airplane on Sunday, so I did not get to watch that show. But I certainly will put it on something to watch so that I can speak more relevantly to that.
He said that the Buffett index was at its all-time high, and the Shiller-Cape ratio was at its third highest, I think. Mm-hmm. And so that was where the figurations he was using to be concerned. Yeah. And does that factor in to any of the thinking here?
I mean, again, so those elements, are of concern. Those ideas indicate once again that the market could be high. Mm-hmm. And as the chart I showed you, that creates a forward expectation for stocks that, again, statistically is that they're going to have muted returns. And as we know, because we experience this, muted returns in stocks aren't like a nice, easy line. Like if we go back to our 2000 to 2013, we had two drops of 50% in the stock market, and then they came back. So the pain of that time was not, the market's return zero. It was like, I'm down 50%. Yeah, I'm up 100%. Oh, I'm down 50%. And, we talk about time to recover and all of those things. So again, that's a very challenging concept because those things are true, right? But it's also why we would say, if you are thinking, the Buffett index is at an all-time high, and the Cape ratio, and I don't have a lot of time to recover, you should come talk to us, and we can talk about reducing your risk, because that would be what we can do in response to that. Because the way that we look at it, there are lower risk asset allocations that we don't, not only even the stock portions of it actually have some non-stocks like high yield bonds, which again, high yield bonds are way more risky than regular bonds, but as a stock comparison, they tend to be less risky while giving you generally, lower stock-like returns, but like they're bonds, so you have some legal recourse. So it's like, if you say I'm going to buy AT&T because it's a low risk stock, maybe you get the same return from a high yield bond. I mean, again, all of this is in theory. So the challenge to that is, yes, those things are real, but that doesn't mean that stocks won't do well. But it does mean that there is a risk of, if you go back a couple of slides, I mean, there is a risk of these time periods because, I mean, look, since 1950, these time periods, the green is the all-time high where there's no green. You know what I mean? And what do we do with that? And all we can do is to say, maybe you want to take less risk. And then people then tell you, well, what about all the debt that the U.S. is taking on, right? And the fears of that, and that's real. I mean, at some point, even the U.S. can't take on more debt. But the problem with that is some people are saying we're there now, and some people will tell you it's 20 years away. And so we as financial advisors have the tools of the financial assets. And so that's where we can build that asset allocation for you. And you can have a real conversation about that in terms of, how little you want to be in stocks. But again, people are like, well, the U.S. debt. And I'm like, well, again, if the U.S. debt, your bank accounts are, the banks hold U.S. debt. Everybody holds U.S. debt. So if we can always think of a scenario where, if the U.S. debt goes, we're not going to be able to move things around and make it better. I mean, the dollar is predicated on that, all of those things. But as Sonia, I'm kind of stealing some of her conclusion, but those things could happen, but they probably won't, And so it's kind of like, if we live on the vibrating edge of all the bad things that could happen, you can go to cash and sit and hold US dollars, and then the value of the dollar could drop. So, significantly, because, you should have been in gold. Again, that's not a recommendation. Again, I have to be very careful because we're recording this in terms of but it's not a recommendation. I'm just saying it's the asset allocation concept gives us this idea of I'm in some stocks, I'm in some bonds, and, we're going to trust that will, produce a result that, is manageable.
And I think that, again, when we look at those bricks in our wall of worry, it's one of those bricks, right? Does that mean that it's absolutely going to happen? Not necessarily, no, it doesn't. But what it does mean is we have those conversations. We talk about, most large negative movements in the market have about a 2-year recovery period. There are always outliers to the norm. But so we talk to our clients, what are you going to need income-wise for the next 2 years? Let's set that aside in a more stable environment. That's how we manage risk. That's our recommendation. Let's talk about cash flow planning. Let's make sure that while we run model portfolios for our clients because it's efficient and it's a great way to equitably serve your clients, we also do them in a very personal basis where we talk about you as an individual and what do you need from your portfolio in the next couple of years, because I'm going to be more cautious with that money and I may not use it. In this year, markets are rising. I'm not going to use my stable reserve to manage cash flow. I'm going to keep pulling cream off the top. But I'm going to keep that stable reserve for the future so that if and when that market environment comes, okay, well, maybe we don't have to sell from stocks when they're down 20%. We're going to use our stable reserve to provide for cash flow for our individual clients. And so, yeah, it's a lot of finessing, I will say. It's a lot of reading, understanding where the risks are, understanding what the relevance to history is, and trying to do your absolute best to make sure, we're looking at it from all facets and paying attention. And so hopefully you find these quarterly updates helpful to kind of get an understanding of where we're at when it comes to our portfolios. That's kind of the goal of all of this, is just to keep that conversation going, keep those updates going. It's been an interesting year. There's been a lot to talk about. There's been a lot of resolution to things that felt really, really scary in the moment. And I look forward to more resolutions for those things. I am an optimistic person, so I will say that, but I'm also not an ostrich. So in keeping with our time, I am going to kind of wrap us up just because we do have a time limit. We will all be available out in the lobby. You're welcome to hang around. We've still got some lovely refreshments outside. Thank you so much for joining us today. We hope that you found the information beneficial, and we look forward to further conversations with you.